Disney has one of the best brand moats in the world, but the pandemic was still able to severely impact its businesses, especially in the theme parks and cruise line segments. So is this decline a value investment opportunity, or are we still overpriced here for Disney? Stick around to find out as we talk about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we're going to analyze Disney's business and earnings results. We'll start with a full analysis of the financials, the amazing top line and bottom line beats they had this quarter, the balance sheet, the cash flows, and finally we'll conclude with an evaluation of this business using our intrinsic value calculator, which will identify whether Disney is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be analyzing this business in 5 minutes, so let's jump into it. So Disney, an American multinational mass media and entertainment conglomerate, what are they focused on? Well, let's take a look at what the CEOs just mentioned. And as you can see here, revenues grew about 26% this quarter, along with their great growth in their earnings per share figures down here. And the CEO reiterated that they had an excellent quarter, and it was driven by their performance at their domestic theme parks, big increases in live sports viewership, and significant subscriber growth at their streaming services. 14.4 million Disney Plus subscribers were added, so they now have 221 million total subscriptions across the globe for their streaming services. That's almost a quarter of a billion. Those are some nice numbers there on their streaming segment. But what are they focused on specifically? According to the CEO, they're focused on continuing to transform entertainment and exceeding customer expectations. All right, so let's jump into the statement of income here. And as you can see, we had revenues for this quarter of 21.5 billion. This is up that 26% from last year of 17 billion. We deduct our costs and expenses. They said this ticked higher due to programming costs, marketing costs, etc. And we're left with about $2.1 billion in income from operations. Then we deduct our other taxes, etc. And we're left with $1.5 billion in net income, which again is up year over year. And when it comes to our earnings per share figures, we can see that here we're left with about 77 cents of earnings, diluted earnings per share. So a strong increase there on that front. And then when we look at this from a 9 months perspective, we're also doing much better than last year, as we did have a lot of lockdowns, especially with their theme parks and such, which caused the slowdown here. But we're back up to about $1.63, almost $2 for the year. So keep that in mind when we come back to our calculator at the end of the video. For now, let's take a look at the balance sheet here. And what you can see is that we have cash and cash equivalents of about $13 billion. And when we compare this to our debt figures here, we have about $5.5 billion in short-term debt, $46 billion in long-term debt. Let's just call it $50 billion in debt for simplicity purposes on the $13 billion in cash. Yeah, on paper, that doesn't look too great. But then when we look at our total current assets of $31 billion, they have content assets of about $34 billion, some goodwill as well, lots of PPE here. Yeah. It seems like this debt should not be an issue for Disney here. Now let's jump into the statement of cash flows here to see how this is translating into their cash positions. So we take down our 9 months figure here of their net income, which is $3.3 billion, add back in our non-cash cost, depreciation, amortization, content costs, etc. We're left with still $3.5 billion in operating free cash flow. We deduct about $3.8 billion in capex. So we're left with a cash outflow net. So what can Disney really do with that? Well, they just use some of their cash position on hand to reduce some of the debt here. Again, what you have to understand here with Disney is that they are still on the rebound here from the losses they incurred during the pandemic. So we have to take a look at some of their historical results to estimate what they can get back to, assuming they can rebound to their financial metrics that they were achieving pre-2020. All right, so looking at their historical earnings per share figures here, this is 2013. We can see they went from $3 in earnings per share all the way up to about $8, and then we were impacted. This is 2019 here by the pandemic. But we got all the way up to $8.36 in earnings per share. And analysts are actually projecting that on a normal basis, they can probably get back to that $8 in earnings per share figure by 2025 and even higher by 2026. But for a conservative estimate here, let's use about $5 in earnings per share for Disney based on their growth assumptions here. So if we plug that figure into the calculator here, $5, we do require a 10% return. They used to pay a dividend, so currently they do not, so we won't put that into our calculation. Our 5-year earnings per share growth rate is actually down, but that again is due to the poor performance of recent times, so we won't be using this figure. It is a little wonky here. If we can assume that Disney can grow at 10% for the first 5 years and then normalize out at about 7% for the 5 years after that on a 20 PE, we can see the stock down towards $89 per share. The stock is currently sitting at $112 per share, so that does not look good. So we have to boost our estimates here, and let's be a little more optimistic. This quarter alone, we grew about 26% in earnings per share. So let's assume for the next 5 years, we can keep that, and then we'll drop down to about 15% growth rate on a 25 PE. The stock will be worth $282. Now, again, that's inflated quite a bit due to this number here. If we drop this down to 15% for the next 10 years, again, it's still a nice stock appreciation from where we are currently. And then the worst case scenario, let's say Disney cannot grow any further. On a 15 PE, the stock should be worth $31. Now, if growth does start to come in here with Disney, I guarantee you they will reinstate that dividend here. And let's see how that impacts our figures here. And as you can see here, even in the normal case where we can expect Disney to grow at about 10% and then 7%, and on a 20 PE, we'd be looking at about $140 per share. So again, a decent amount of upside here for Disney. And you can guarantee that if they do reinstate that dividend, the stock will pump higher because investors love their dividends. But if you're wondering why our estimates here for the normal case scenario are pretty low, it's because of their PE ratio here being at 77. The market cap is sitting at $205 billion, so that makes it a little bit expensive here, even though they have declined 40% since March of 2021. The other issue here that I have with Disney is that they do have that streaming competition war going on with Netflix, Amazon Prime, Warner Bros as well now. So there is a lot of competition in this business space here. But as we said at the top of the video, Disney does have one of the best brand moats around. So I don't foresee that the stock will actually end up much lower. And actually, if we look at this after hours and based on the report here, we can see that the stock is actually up about 6% after hours. So Wall Street did like this report. And actually, it looks like some investors are expecting this stock price to appreciate here, because what I have up on the screen here is the options order flow for Disney here with the expiry by the end of the year here in December. So it looks like there's a lot of call option coming in here for Disney in comparison to the put option. So we can definitely estimate that the stock price will appreciate from here. But that is the analysis with Disney. As always, please do your own due diligence when it comes to research and your investments. If you enjoyed the video, please leave a like and subscribe, and I'll catch you on the next one.